Good morning, everybody. It is 11:30 on the dot. I see we still have people joining us. So just a very, very warm welcome to all of those of you who are able to join us live for this. If you're watching the recording, you will get all the information, but you won't have the opportunity to ask live questions, as our live audience will be able to do. While we're waiting maybe for a few more people to join us, just to remind you that we will have an opportunity towards the end for us to answer some of your questions. Please feel free to put those in the chat right throughout the session, and certainly we will be answering as many of those that we can. You can also reach out to us by replying to the email address seminars@etfsa.co.za, which is the email address from which you received the link to this webinar this morning. So feel free to reply to that email. Feel free to contact us via any of our normal channels, as you might very well be familiar with. And yes, we're looking forward to spending this time with you this morning. It's 1 minute after the start, so I think I'm going to get going and actually start with our session for this morning, which is really introducing the ETFSA Oyster Global Balanced Prescient Actively Managed ETF. It's quite a mouthful, but then so is the world. The world is a big place. The world is a massive place. How can we as South African investors best make use of the opportunities that are available to us in the global investment space? So let's start and think about, how does one actually construct a balanced portfolio, a global balanced portfolio for South African investors? Now, many of you might have heard of the classic 60-40 portfolio. Now, 60-40 typically refers to the split between growth assets and income assets, 60% in growth, 40% in income assets. But when you are a South African investor and you are now building specifically a global portfolio, so this is not your overall portfolio or asset base that we're talking about, this is specifically a global portfolio, that traditional starting point of 60-40 really isn't appropriate for us. Why not? Well, for starters, us as South Africans don't need to go offshore for yield. We don't need to go there for interest yield. We don't go there for dividend yield, because South African interest rates and South African dividends are typically far superior to what we can get in global markets. So we certainly wouldn't be looking for that classic income component coming from offshore markets. Rather, what we want to focus on is the opportunities for different and diversified sources of capital growth that we don't have available in our local market. So we believe that a much more appropriate basic starting point for a South African investor is to have a long-term anchor of 80-20 between growth and income assets. And in this context, we use income assets really as a portfolio stabilization mechanism in a balanced portfolio. It's not about the yield, the interest, or the dividends that you look to receive from the income assets. This is rather about portfolio stabilization, risk management, if I can put it that way. I think the other important aspect for us is that when we talk about growth assets, it's quite important that we appreciate that it's not just equities that we are talking about. Listed property definitely is also a growth asset, and there are so many alternative types of investment opportunities, most specifically physical commodities, and we consider all of those growth assets within a portfolio. And when we look at what is typically available to South Africans in the South African market, when we look towards the ASISA fund categories, the Associations for Saving and Investments in South Africa, typically we find that within ASISA, when they talk about growth, there seems to be some sort of fixation almost on equity, specifically as exposure within growth. Often we don't see any reference to physical commodities, and even the reference to property is also far less than what you would see coming from equities. But the other thing that we find very much in the South African investment environment is that our industry seems to be quite fixated on Regulation 28. Now, Regulation 28 is something which is only applicable to retirement funds, pre-retirement funds, so retirement annuities, pension funds, provident funds, preservation funds, and so on. And yet the industry prefers to construct investment portfolios, typically unit trust portfolios, that are Regulation 28 compliant, even if you are looking to use these investments in portfolios other than your retirement savings. So what's readily available in the industry when it comes to balanced funds typically restricts itself to what Regulation 28 allows. But the reality is that the real world has moved on, and our opportunity set in global markets is so much more than this almost restricted view that most of the industry have, and certainly within a Regulation 28 context has. And we want to free ourselves from those types of constraints and really look to how can we best make use of these opportunities that we've got available in global markets. So our investment philosophy in the Oyster ETF really is focused on three components. It is a global first, and I can almost say global only investment philosophy that we have. We follow a core satellite discipline, and I'm going to explain that in a bit more detail. And we focus a lot on the design of the portfolio, the construction of the portfolio, certainly not on individual underlying stock picking or individual security selection. What do we mean when we say global first? Well, we want to make sure that we get the broad access, not just to developed markets, not just to the US, but really to the full opportunity set that developed and emerging markets offer us. We want to make sure that in constructing our portfolio, we get exposure to multiple product issuers, ETF issuers. And we are very familiar with our South African issuers, but in the global market, there are many larger, bigger, and very prestigious issuers available to us. We want to make sure that we're able to get currency as well as regional diversification to make sure that we move beyond what is readily and typically available in the South African market, which often is mostly about US, equity, and dollars. So we want to move beyond that. The core satellite principle really says that you start with a core portfolio which is well diversified between global equity and fixed income. But then in the satellites, we want to add tilt exposures by incorporating thematic exposures, incorporating alternative exposures to tilt the portfolio in the direction of where we believe best opportunities are at any point in time. And we do that very much with a rules-based approach. So yes, it is an actively managed ETF because it doesn't track or follow a specific index, but there's very much a strong structural rules-based approach to how we do it. Fully transparent process. We fully disclose what we have in the portfolio at any point in time. We also want to focus on the benefits of the cost reduction that we can get by making use of exchange-traded notes over and above the exchange-traded funds that one might be more readily familiar with. But the notes give you very good targeted exposure to the opportunity set that you want, but you can do so at much better cost. And really our focus here in our philosophy here is that we are looking at long-term compounding of wealth. This is about wealth creation, wealth building over time. We are not looking to try and time the market and what is our perfect entry point into a particular asset class. This is about long-term investing and long-term asset growth. So let's have a look and see what does the global opportunity set look like. And I'm going to focus specifically here on the global equity opportunity set. And I want to differentiate between what the world would look like from an economic perspective versus what's available to us from a market, an equity market perspective. And if we look at the long-term trend line in terms of the proportion of advanced economies or developed market economies relative to emerging market economies, you see that since 1975, we've seen this split all the way up to 2010, really on a trend line that would project that by 2030, that split should be just 15% from developed markets and 85% from emerging markets. That's certainly not our sense of how we think about the world. Now, it is so that since 2010, it seems as though we've reached a bit of almost a bottom, if I can call it that, and some sort of balance. The current split is 38% developed markets, 62% emerging markets, and we do believe that a 40-60 split between developed and emerging markets is probably an appropriate level where we should expect the contribution to global economic growth to even out. So 40-60 split, very much in favor of emerging markets, in other words, a lot more growth coming from emerging markets than coming from developed markets. However, when we look at what's available to us from equity markets, the picture looks very different. In this situation, we find that developed market exposure currently constitutes almost 90% of our global equity opportunity set, with just a little bit over 10 coming from emerging markets. That trend line from 1975 would suggest that an 80-20 split between developed and emerging markets is probably the more the realistic expected level of where we want to be. And you might ask yourself, why such a big difference between the makeup of the world from an economic growth perspective versus from an equity market perspective? And the answer is really focused on two primary issues. The first one is that economic growth, it's domestic product. In other words, it's about what domestically can take place in an economy, and therefore is something that is not going to move beyond the borders of a particular country. Whereas capital markets, equity markets, capital flows freely, mostly freely around the world. So capital markets, you can find that a lot of equity market capital from emerging market flows to developed market, which brings me to the second point, and that is really that capital flows where it is most appreciated, where the markets are the deepest, the most liquid, the most advanced, and that's certainly where our developed markets would find themselves. We also know that over time, access to emerging markets have started to open up. Used to be quite challenging for many investors around the world to invest in equity markets, in emerging markets, but that continues to open up. It continues to be liberated. And so we are comfortable to really look at a split of 80-20 between developed and emerging markets. And from that perspective, I really want to quote Wayne Gretzky, who said, "I skate to where the puck is going to be, not where it has been." In other words, we can see a 90-10 split in global equity markets at the moment, but we believe that it's more appropriate for us to move somewhat closer to what the economic growth argument would be, and that would be an 80-20 split between developed and emerging markets. So let's go back to our portfolio design, building our global balanced portfolio for South African investors. And the first thing that we're going to do is to say our strategic allocation. I argued on the very first slide why we are in favor of 80 growth, 20 income exposure, and that would be a long-term strategic allocation for us to those two sort of major asset buckets. But we have a periodic tilt from time to time, and currently that tactical tilt for us is in favor of growth assets and somewhat less in income assets. So an 85% growth, 15% income at the moment. Coming back then to the argument around the equity exposure split, we're going to go for an 80% developed market, 20% emerging market split. And so we can continue to drill down in our portfolio construction process and say, okay, so within our developed equity market, how are we going to look at our split in terms of that? Now, we know that purely because of the construct of the likes of the MSCI All Country World Index or the FTSE All Cap Total Equity Index and so on, it is very much dominated by developed markets, which is dominated by the US, and which in turn is dominated by those Mag 7 companies. So we know that when we start with a core exposure, when we start there, that's what we already have a lot of. We've got a lot of US, we've got a lot of tech. So where do we go? Or Mag 7, I should rather say. And so for us, the important thematic tilts that we have in the portfolio at the moment is AI and technology, despite what we get in terms of our Mag 7 companies, for us that remains a very strong long-term trend, and we want to make sure that we've got sufficient exposure to it. I'm going to take you into a bit more detail in terms of how we get exposure to that in a short while. But suffice to say at this stage that we absolutely want to have an overweight position to AI and technology, but we want to move beyond Mag 7. We want to make sure that we cover a much more broad-based view of tech. The next thing is to acknowledge that the equity market exposure in the US is absolutely dominated by not just the Mag 7, but by the very large, those ultra large cap companies, the S&P 500 companies. But we believe that the economic and the market opportunity in the US is more broad-based than that. And so we're going to put a specific exposure to US mid-caps in the portfolio as well to make sure that we capture a broader exposure to the US equity markets. And once we've now added more AI, technology, and US mid-caps to our portfolio, we suddenly find ourselves in a position that is now unnecessarily and probably improperly overexposed to the US market. So to counterbalance that, we then specifically add an exposure to developed markets excluding the US. So there you're looking at Europe, UK, Canada, Australia, the much more broad-based developed markets outside of the US. So that's within our equity bucket. Within the interest-bearing or the income bucket then, we are certainly at the moment very aware of the pressure that there are on traditional long bond yields. And in acknowledgement of that, we are going to shift and tilt the income part of the portfolio more towards what we would refer to as the shorter end of the yield curve. Money market funds, diversified income funds. So 5% exposure to, let's call it a money market fund, for lack of a better word. 5% exposure to corporate bonds, not only because they give us a higher yield, a higher interest pickup than compared to sovereign or government bonds, but also because they tend to fall more into sort of a 3 to 5 year time horizon, a maturity there. And then only 5 of the 15% we maintain in broad-based government bond exposure, I shouldn't even say government bond exposure, investment grade bond exposure. So that's currently the makeup of our interest-bearing exposure. And then for us, a very important diversifier in the portfolio is to add that alternative exposure, which is physical commodities. So commodity exposure, specifically physical commodities. And where we find ourselves at the moment, you'll see that our specific exposure there is in precious metals, gold and platinum specifically. But we end up with a portfolio, therefore, that currently looks like that. Our 85% to growth is 75% equities, 10% physical commodities, and the income part of the portfolio, 15% then in the interest-bearing component. But I promised you I would look into a little bit more detail in some of those thematic tilts that we've got going in the portfolio. So the first one that I want to look at is the AI and technology one. And here specifically our chosen exposure is to move towards AI infrastructure. Because what is the investment thesis that we see in terms of this? The real bottleneck that we have in the AI is really the ability to deliver on the technology that is required, the processing power that is required, the electricity supply, the physical infrastructure, the data centers, those sort of things, the physical infrastructure that is required to actually run all these models. So that's really where we want to have specific exposure. Things like chips, data centers, power generation capacity, network capability, and so on. It really is about where and how can that long-term capital be spent for these hyperscalers. We know that the mega cap companies are putting massive capex into this. Where is that capex going? And we want to make sure that we also participate in an aspect of where that big capex is actually being spent. We don't only want to be buying into the Mag 7 companies. We want to buy where they are spending their money. We really want to focus on what's called a pick and shovel sort of exposure. So, or the bricks and mortar, I guess, is the old-fashioned term also in terms of infrastructure that we want to look at. And it really is about getting much more improved diversification beyond NVIDIA, Alphabet, Amazon, those sort of mega tech companies as we see it. So I'm giving you there, and I know it's relatively small, but you can have a look at the Global X AI Infrastructure ETF, which is the one that we use in this particular case. And I think what's quite interesting for us here is that the way that that index is put together is that it focuses very much on the pure play infrastructure companies within that. Whether that's power and energy infrastructure, whether that's data center equipment, thermal management, copper and uranium related raw materials, for example. We know absolutely key minerals in this whole spectrum. But then I also want to invite you to look at the names that you see in those top 10 holdings. I don't know about you guys, but I don't think I know any of those companies, whereas we all know about NVIDIA, Meta, Microsoft, Alphabet, and so on. So this is really for us about getting exposure to something more within the AI space beyond that. Interesting also then that when we look at the geographic exposure of this particular ETF, yes, it still has just over 50% in North America, mostly in the US, but it's also got a substantial exposure in Europe and in Asia. Europe, where we're seeing a lot of renewable energy, a lot of effort being put into data centers and so on, and Asia, an absolute tech powerhouse and hub in terms of that. So for us, a very important exposure to really broaden our exposure to the long-term mega trend around AI and AI technology. The other one that I also specifically want to focus on is what does the US mid-cap exposure look like, and why are we interested in making sure that we get sufficient exposure to that? Well, when we look in terms of the America First policies and the domestic focus that we see in terms of the US, this benefits your mid-cap companies a lot more than your large cap, your S&P 500 companies, who tend to have a much more global exposure. The mid-caps is really sort of your domestic exposure within the US. And this is really where we see a big part of the America First policy traction coming through. Added on top of that, by the way, that of course we've now started seeing the first of the tariff refunds that have had to be paid back to companies. And these are exactly the type of companies that are the beneficiaries of those tariff refunds. The other very important argument in favor of the mid-caps is that from a valuation perspective, they are much better valued than your large cap companies. When you hear talk about the overvaluation of the US equity market, you are typically hearing that coming from those mega cap companies, whereas the mid-cap companies typically, and at the moment, trade at about a 20% discount to the valuation of the large cap companies. So a very attractive way for us to find better exposure in terms of that. The other aspect that is really quite important is because this is more US domestic focused, we find that the earnings of these mid-cap companies have much better leverage to US economic growth. What that really means is that when you get good economic growth, it translates at a faster pace into the earnings of the mid-cap companies. So a really great way for us to tap into that US economic growth, which remains resilient and remains very strong from that perspective. And finally, for us also, again, it is about improved diversification. The S&P 500, the mega caps are very dominant in terms of your IT, your information technology, and so on, whereas the mid caps give you a much more diversified exposure to the US economy. In this particular case, we are investing in one of the State Street ETFs, something which is not readily available to South African investors, much like that Global XAI Infrastructure ETF also is not readily available to South African investors. But we buy into this, and again, have a look at those top 10 companies. Not only are those names a lot less familiar to us, but look at those weights also. No one company completely dominates this index like we find in the case of the S&P 500. And when you look at the sector exposure of it, you see that it looks quite different than the sector makeup of the S&P 500. So for us, a very important way to diversify our underlying exposure, to tap into better valuations without giving up on the exposure to the very high performing US equity market. And then a very important aspect for us of the Oyster ETF is that we have the ability to physically manage the bulk of this ETF in offshore markets, which allows us to buy into ETFs offered by iShares, Vanguard, State Street, Global X, Amundi. We've got so many different issuers. These are massive issuers. Between these top three issuers, iShares by BlackRock, Vanguard, State Street, Spider Products, $11 trillion in assets under management for those ETFs. They happen to also be the underlying hedging or the underlying holdings of many of the South African, the JSE listed ETFs. But we have limited exposure to some of the likes of Vanguard and State Street through this. Seeing that they are so incredibly large, it also means that they are able to offer these at much lower fees. And by buying directly into those ETFs, we are able to bring investors in the Oyster ETF the benefit of the much lower costs of those underlying global heavyweight ETFs that we've got in terms of it. It gives us much better opportunity in terms of these thematic exposures, these niche providers. As I say, you're not going to find an AI infrastructure readily available on the JSE. Some of the other sort of potential products that we are looking, or not products, but thematic exposures, I'll call them our bubbling under exposures that we're looking at, is looking, for example, at the like of European defense. It's about looking at commodities beyond the precious metals that we've got readily available in South Africa. It's about looking at the global listed property, the real estate investment trust. Those are potential thematic tilts that we are monitoring, and when we feel that the time is right, we can introduce those into the portfolio and do so through these mega issuers, do so in the most appropriate currency to get currency diversification, and also ensure that we do the trading in the best listing and execution jurisdictions for the portfolio. So what does the portfolio look like? This is the underlying holdings of the Oyster ETF. And you'll see there that you'll recognize some of those names. You'll see a lot of that core holding, the All Country World Index, the Vanguard, the FTSE All World Index. So those are still our core holdings. But then you're going to find that, that Spider S&P 400, you're going to see that Global XAI infrastructure and so on. I must emphasize that this portfolio, bear in mind that the Oyster only listed on the JSE last month. We are in the process of physically moving the assets of this portfolio from South Africa offshore to be able to buy into this. We are not in a position yet to have a proper MDD, a minimum disclosure document. It's a new CIS, it's a new ETF in terms of that exposure, and the FSCA restricts us in terms of what we can disclose in a formal fund fact sheet. But what I can tell you is this Oyster strategy is one which we've been running inside our living in annuity since August last year. So it's been running for almost 2 years. And we are applying exactly the same strategy that we've got for the LA Oyster portfolio in this Oyster actively managed ETF. And so what I'm showing you here is the performance of the LA Oyster portfolio. We don't have and we can't show you longer dated history of the Oyster ETF. But this is exactly the same strategy that we've got there. You might also look at those since inception numbers and say, oh, that seems a little bit pedestrian. What, you only got 10% per annum, only 10% per annum. But I want to remind you that since August 2024, the rand has strengthened by 12% against the dollar. From around 1840 to where we are this morning, sitting at around 1620, 1630. No, it doesn't always feel like the rand has been strengthening, but it has been. And that type of rand strengthening constitutes approximately 7% per annum. And when you're investing in a global product such as this Oyster AMETF, what you will find is that when the rand strengthens, as it has over the last 2 years, your returns in rands therefore are lower. When the rand weakens, you will find that that boosts your returns in rand terms. So effectively, what you're seeing here is the impact also of the currency in terms of that. But for us, the reason why we go and invest offshore is because we want to get that diversified exposure, that opportunity set to buy into capital growth that's not available in South Africa. For us, this is not about, I believe the rand's going to depreciate, I believe the rand is going to appreciate. We're not looking to generate return from the currency, from the exchange rate. We're looking to get our returns from that diversified capital growth opportunity set in offshore markets. So in summary, really, sort of where do we, there's some of the quick facts around it. We are doing this in partnership with Prescient as our manco. Current AUM, 275 million rand already as it is listed on the JSE. You'll see that our management fee on this is 0.35%. We expect the total expense ratio, which includes the cost of all of those underlying ETFs, to settle somewhere between 0.5 and 0.6%. We are not allowed to disclose a total expense ratio until the fund has been in existence for a year, but you can get a sense there of what we expect this to be. It's available via all JSE stockbroking platforms, but of course, it's certainly available via the ETFSA Investor Hub. And as ETFSA clients also, we make extensive use of this product across our discretionary investments, still in our living annuity, but very importantly, this Oyster ETF qualifies for tax-free investment accounts and is, in fact, the only ETF listed on the JSE that is qualified for tax-free accounts that will give you access to physical commodities, gold and platinum. You can't buy those on their own, but you can buy it as part of the Oyster ETF. So in summary, really, what is our strategy? We're looking for a globally diversified multi-asset ETF. We blend growth, income-generating assets, and we do so by really creating a curated basket of offshore-listed exchange-traded products. What does this investment offer? You can see the detail there. I've gone through all of those opportunities. It's 100% offshore, but you are able to buy this from the comfort and the familiarity of the JSE, meaning you don't need any offshore brokerage accounts. You don't need SARB approval to take money outside of the country. Via this ETF, you are able to buy into those offshore markets, readily available as is, without any of those other types of ways of expatriating money out of South Africa. Why would you choose this fund? Who chooses this fund? For us, it's really about what is the underlying exposure that you're getting through this. To what extent does this offer you the opportunity to get exposure that is not readily available? Exposure to niche and thematic investment strategies, exposure to those large global mega issuers with the low costs that they offer. And for us, this is a great single product, a curated single ETF that gives you all of those benefits in a single product. So that's what I wanted to share with you today. And certainly we have the opportunity now to answer some questions. For those of you that have already put some questions in the chat, we're going to come to those. If you've got some questions now, please feel free to put your questions in the chat. See how many of those we can answer live here. If you don't get your question answered or you're watching the recording, do reach out to us, send us an email, contact us via social media or on the phone, get hold of us and we can answer your questions. So let's have a look at those questions that are available there. I'm going to take us back to our, you know what, maybe I can even get out of our presentation now that I think about it and rather just look straight at the questions that we've got in the chat. So the first question of DGH, so I'm not sure who that is. Why have 11% SA cash versus offshore cash in the Oyster Fund? So I assume that you are looking at the current holdings in the portfolio. The only SA cash that we would hold would be as money flows into the portfolio. Remember, investors are buying on the JSE. They're buying with rands. Rands come into the portfolio. We take that rands offshore. We physically convert it into dollars, into the hard currencies to go and buy those offshores. So from a timing perspective, there might be times that you'll see South African cash sitting in the portfolio, but by and large, that would be a timing issue. That's not a strategic holding that we've got. B410662, gotta love these anonymous, interesting handles. Would you not consider picking stocks over ETFs? Consider you are selecting specific sectors for specific exposure. Would you not want to go one more level deeper within that sector? The easy and straightforward answer is no. We won't do that. That's not our core strength. ETFSA is the home of exchange traded funds. We are the ETF specialists, but not just because of our own capabilities. We believe very strongly that your best way to buy exposure to a sector or to a theme is, as John Bogle famously said, buy the haystack, don't try and find the needle. There is more than enough evidence that shows that the ability to consistently buy into the securities that will outperform in future is a futile attempt. So we would much rather buy the haystack, we would buy the sector, we would buy the theme, rather than try to identify individual stocks within a specific security. Okay, let's see. I have a living annuity. Can I add my existing living annuity? And if so, can I add the global product to it? So if you are an ETFSA living annuity client, yes, then you can. This is available to our living annuity holders as one of our portfolios because living annuities are post-retirement products. They're not subject to Regulation 28, which means you can have 100% of your living annuity or a much larger proportion than 45% in your living annuity in a global product. So it's certainly available, feasible. It depends on where your living annuity is. Will the presentation slides be made available? Absolutely. We will load the recording and with that the slides on our website once this is over and done with. Can this be included in an RA? No. It cannot be included in an RA on its own because it's 100% offshore. And Regulation 28 requires us that at all times we can't have more than 45% in a global exposure. And so no, you would not be able to use this as a standalone product in an RA or any pre-retirement savings. Someone also, Harriet, to ask, is it available for TFSA? Yes, absolutely. A great option for a tax-free investment account, especially for a long-term investment horizon for younger people, people who really want to be, and it's not just for younger people, certainly people my age as well. Great option for a tax-free portfolio where you are looking to tap into the tax savings opportunities that you get from capital gains. Remember, we said we're not going offshore for yield. We're not going offshore for interest or for dividends. This is about capital growth. So you're not going to save tax on interest or tax on dividends in this product in your tax-free account, but you will certainly save on capital gains tax over time. And I think, Jono Twin, I think I answered your question as well, just for the benefit of those that haven't seen it. For the tax-free account, should the Oyster be viewed as a complete one-fund global solution or as a satellite holding along existing ETFs like MSCI World, S&P 500, ACWI Global? So, Jono, no, this for me is absolutely that core one global fund solution, either to be used on its own or to have that as your core exposure, and then you can rather add specific additional exposures that you want to add in your portfolio, but that you don't necessarily have in the Oyster. By adding MSCI World, S&P 500, ACWI Global again to the Oyster, you're just doubling up. And you're doing so at much higher costs than what you would be doing through the Oyster. So I certainly would not recommend that. I'll see the Oyster as my core holding, and then I would look to add things. Diversification comes from adding things that look and perform differently from that I already have in my portfolio. So I would be looking for things that look and feel and smell and act and perform very differently. I hope that helps, John. So you say you're currently using global, so the Sharecade Global, so that's the 10x total world equity exposure as your core exposure. Great core exposure. You'll see that basic exposure, which is the FTSE all cap, all the total equity exposure in the world, that is a core exposure for us in the Oyster. but we supplement that. We go beyond what global would currently give you. Global, great option. I think Oyster now gives you more of the world than what global would be giving you in terms of this. Right, let's see. Am I missing any other questions? Oh, Natalie, thank you. I think that's a great question. You're asking, why is it called actively managed? It's such a good question because I think for many people, it invokes the sense of, oh, this is something where we're sitting there day in, day out, buying, selling, stock picking, doing all sorts of things. The JSE's listing requirements state that unless an ETF tracks an index, it has to be called an actively managed ETF. Tracking an index basically means that you are literally buying all the constituents, all the securities of the index in exactly the same proportions as they are in an index. There are no generally accepted global multi-asset benchmark indices available. So from that perspective alone, it would almost be impossible to go and buy an index tracking global multi-asset balanced fund portfolio as we've got it here. But then in addition to that, in this particular ETF, we do actually tilt a little bit from our long-term strategic asset allocation, which is a second reason why it is called actively managed. But very importantly here, this is not something where we are sitting day in, day out, trading this portfolio and managing it actively from that perspective. Great. Lamalang, thank you very much. I like what you're saying. It's an informative presentation. It's a real buy, Thank you very much. Aubrey, that's asking, can you get a monthly income from this fund? Definitely not. Definitely not, because it's not the objective of this fund. This fund objective is not to deliver income, neither interest nor dividends. Global interest rates are significantly lower than in South Africa. Global dividend yields are much lower than in South Africa. By the way, do you know that the S&P 500 dividend yield is less than 1%? South African equities, on balance, are upwards of 3% and more. So this is a global fund. We're not looking for dividends. We're not looking for interest. So definitely is not suitable for somebody who needs or wants monthly income from their portfolio. Annalene asks, what's the minimum to invest? Annalene, it is one security that you can buy, which currently trades at just over 10 Rand a unit. So the minimum would basically be the 10 Rand that it costs you to buy one unit. So there are no minimums. You've got to consider the cost of investing. So depends on the platform that you use, the stockbroking account that you use, and how your transaction costs and your settlement fees relate with that. But there's no specific minimum for this particular one. So Visa asks, what expected annual return would we expect or project net of costs? That's an incredibly difficult question to answer. It's impossible to give you an expected return for any investment that is focused on capital growth. The majority of your performance here is going to come from changes in the prices of the underlying ETFs. When you are investing in a money market fund or in a fixed interest account, your ability to project a return is much easier because a big part of that return is predefined. It is that fixed interest rate that you're getting. In a capital growth product like this, it's incredibly difficult. I can sit here, I can suck on my left thumb, suck on my right thumb and say to you, well, I guess it's going to be 5% real. It's going to be 20% in Rand terms. There are way too many variables. We're not looking to try and predict this service. But I'm sorry, I'm not prepared to make a projection or an estimate in terms of what the return this will be. This is about buying into the global investment opportunity set for the long term and ensure that you use that as the primary vehicle to build your wealth outside of South Africa over the longer term. This is not about a short term in and out trying to sort of achieve a specific one. Right, I see John has got a follow-up question using the global and just trying. If I want lower volatility and a manage a multi-asset approach, in other words, does Oyster aim to outperform global over 10 plus years after fees, or is the goal mainly smoother risk-adjusted return? So certainly by going to a balanced fund rather than an equity-only portfolio, which is what global is at the moment, global as an equity-only would be expected to have higher volatility, whereas the income component, the balanced fund component that we introduced into this would give you a somewhat smoother ride, but bear in mind it's a relatively modest income exposure that we currently have in the portfolio, 15%. So you're still going to get significant, call it volatility or variability, especially considering that that's in Rand. I would expect that the Oyster portfolio over the long term should give you a better risk-adjusted return than global, even though the return itself might not necessarily be better than what global gives you. So it is about bringing in that diversification. It is about bringing in that broader view rather than just the equity view that we've got into it. Right. Tsepo says, how easy is it to get money into the ETFSA account besides the debit order? Well, you can just make a deposit. If you're talking about the ETFSA Investor Hub, it is administered for us by Wealthport. Wealthport is a public beneficiary on your internet banking. So as soon as you have an account open on the hub, and the hub gives you both a discretionary investment account as well as a tax-free investment account, once your account is open, it's as easy as making a payment to that public beneficiary, Wealthport. You go onto the hub, log in there, you put in your investment instruction, and it's as easy as that. Tsepo also asks, what's going to happen to the international model? I love an informed client. So Tsepo, in fact, the international model, for those that might not know, that's one of the model portfolios that we had available in our tax-free offering. We've replaced the international model with the Oyster ETF for the simple reason that the international model, because we needed to be able to accommodate 1,000 Rand at a time, a relatively modest amount at a time, we could only buy 5 specific ETFs for you in that international model, 20% each, so quite crude diversification. Now, by putting the ETF there, we can accommodate much lower amounts, and yet you still get a much more diversified offering, still within this international objective, this 100% global objective. So the Oyster is a much more efficient model, if I can call it that, for our portfolios than the international portfolio was going to be. Great. Anna says, thank you for a great investment vehicle in my living annuity, and I'm happy with its potential and current performance. Thanks, Anna. Appreciate that feedback. Jonathan, thanks for the presentation. You also ask about minimum first-time buying on the ETF Hub platform. We typically look at a 300 Rand as a minimum investment amount on the Hub platform. We also believe that, starting with that, it's an achievable amount. So it's not about trying to sort of stop people from being able to invest. But I think if you're not able to afford 300 Rand, I think you need to seriously ask yourself also whether you are actually ready to take an investment opportunity, not just in the Oyster, but in any investment opportunity. So, Jonathan, hope that answers that question. Judy asks, what do you consider long-term as an investment? Typically for me, long-term means at least 5 years. But typically we would think 7 to 10 years and beyond is what we're looking at. Why do we say 5 years? If we look at the very, very long term, there have been hardly any periods in time where over rolling 5-year periods, you've had negative nominal growth. Might not quite achieve inflation, but negative nominal growth. So despite all the serious ups and downs that we see in markets, which is to be expected, we want to have that variability, because variability is where the opportunity for capital growth comes from. But at least 5 years as far as I'm concerned. And as you move 7, 10 and beyond years, you find that your probability of not even achieving an inflation adjusted return, so a real return, virtually disappears. So Judy, that is my view in terms of what I consider long term. Cece, thank you very much. So informative and insightful, eye-opening too. Love hearing that. If we can leave people more enlightened and informed after the half hour that you spent with us, then my job is done here. Kaylee that says, quick question, does the expected TR of approximately zero point 0.6 include the 0.35? Thank you, thank you, thank you. You ask great questions. Yes, it does include that. So the total expense ratio is the management fee plus the cost of those underlying ETFs that we hold in the portfolio, plus any administration charges, trustee fees, all of those types of costs inside a portfolio. You know, when you are dealing with a well-regulated vehicle, such as a CIS, a collective investment scheme or unit trust, as an ETF, you have to expect regulatory charges. That's what safeguards you as an investor. So the 0.35 management fee plus the cost of those underlying ETFs plus those regulatory and compulsory sort of charges, we expect it to end up 0.5, 0.6, somewhere around there. Anneline says, what's the longest period or shortest period to leave the money in? I'm not going to dictate to you how quickly you should take money out. This, in my view, is a long-term investment. Your view in terms of how long you want to leave the money in should be long-term. Because it is a listed security, a listed ETF with a market maker sitting behind it, you can buy and sell it on the same day. It can be as short as that. That's not our recommendation. That's not the intention with this, Unlean. So I certainly would not buy into this with the intention to take my money out quickly. I want to get my exposure to the world for the long term. Lamalang that asks, does ETFSA have an account for stokvels and investment clubs? Absolutely. And I see that we do already have an answer in terms of that. And I think the important thing around that is that ETFSA are also registered financial advisors, which means not only can we advise individuals on your investment wants and needs, but we can also do so for stokvels and for investment clubs. You also, Modilara asked a question and says, with due respect to President Trump, who is destabilizing the world markets, are you not exposed to undue risk? This is informed by investment in US-based markets. How will we mitigate this risk? So with all due respect, despite the destabilizing force that President Trump has been in what's happening in the Middle East, the S&P 500 last night once again made a new all-time high. So yes, we have chaos in the world from a logistics perspective in terms of getting product supply, oil, fertilizer, these sort of things out of the Middle East. And yet, despite that, we still find that equity markets, and in particular the US equity markets, continue to perform really, really well. Why? Actually, exactly because of that AI and technology focus. But even as we move down the spectrum in terms of the US economy is probably the most resilient and most protected from what is currently happening in the Middle East. Not only are they energy and food self-sufficient, they also physically very far removed from the Middle East. And so the US actually stands to come out of this a lot stronger than many other economies. So I think we need to separate what is happening politically, geopolitically, and in terms of inflationary impact of the high oil prices and the fertilizer prices and so on. We need to separate that from the equity market performance and what is driving the performance of those equity markets. Yes, there are risks in the US equity market. Yes, there are risks in all global equity markets. That's what we buy into when we buy into global equity opportunities. This is not a risk-free or a riskless investment. This is about a long-term investment that we're looking to grow our wealth over time. And right throughout all the decades of world wars and famines and pandemics and lots of global geopolitical uncertainty, equity market performance have given you real, in other words, inflation adjusted outperformance over time. It is the only way to keep up with inflation, is to actually expose yourself exactly to the risks that equity markets offer you. Right. Are dividends reinvested? Asked Kamlesh. No, there will be a portion of dividends that will be paid out. So, in other words, it is a distributing ETF, but there are very limited dividends and interest, and quite a few of those underlying ETFs do actually reinvest the dividends that they receive. So, Kamlesh, we are not reinvesting the dividends that we receive into the ETF, but there's quite a bit of the dividends that do come into the underlying investments that will automatically be reinvested. Right, grace of God, do I have to give you instruction to add Oyster to my tax-free portfolio? Yes, unless you were invested in the international model portfolio, where we automatically replace that with the Oyster. If you want to add it to your existing tax-free investment portfolio, you have to do so yourself. Tebogo asks, can you please share the presentation with all of us? Yes, we certainly will have it available on our website, both the presentation as well as the recording of this. And I think very importantly, for those of you that haven't had your questions answered or maybe watch this recording and have questions, do reach out to us. And Pamela says, in the event of a market correction, how fast do you rebalance? So Pamela, depends on, I guess, what is affected by a market correction. If it is a global market correction, everything will adjust simultaneously, so there's no rebalancing required. We don't specifically go and rebalance on a quarterly basis or on a monthly basis as you would in an index tracking portfolio that has a quarterly index rebalancing process. We continuously monitor the investment portfolio and the investment opportunity set. As ETFSA, we have both an internal and an external investment committee. Our internal investment committee meets once a month and reviews these portfolios, including the Oyster portfolio. Our external investment committee meets once a quarter. And with all of these, we continuously monitor what is going on. So there may be changes to the portfolio on a monthly basis. The fact that we review it, that we assess what's going on in the market doesn't necessarily mean that we make big changes. But I think what is important is that we do monitor, that we do look at this, and if and where we do make changes, expect it to be more on the fringes, on the edges. It will be in the thematic tilts. Your core exposure will remain intact because it is buying into that global opportunity set. It's on the thematic tilts that we might make changes from time to time. Great. Let's just see. I see we've got some direct questions also. Okay, I see that one has been answered. Oh, wonderful. Anisha. Anisha asks, is this Sharia compliant? No, unfortunately not. For the simple reason that there are many of those underlying holdings that have not been specifically screened for Sharia compliancy. It does have interest-bearing components in the portfolio. Those would also not be Sharia compliant. So, Anisha, no. Unfortunately, this particular Oyster portfolio is not Sharia compliant. Right, anything else? Let's see. I think we've answered most of these questions also in terms of like minimum investment amounts and so on. Wahidu says, can advisors market ETFSA products? Yes, you certainly can. You're welcome to reach out to us for a specific conversation so we see what it is that you're looking to do. Obviously, we can only deal with registered financial advisors, or FSPs or representatives in their own right. But Wahid, you're more than welcome to reach out to us for more information. Pamela, thank you. Thanks for all the information. I certainly like what I've heard. Thank you, Pamela. Appreciate that feedback. We are coming up for the hour. I think you've been very generous with the time that you've given to us, the attention that you paid. Thank you for all the questions, some great informed questions that we've got. We really appreciate this. I'm going to call it a day at this point. I think we've covered the important questions that have come through. Thank you for spending the time with us this morning. Happy investing, strong investing, good investing. Stay invested and stay diversified. And I wish you all a wonderful and healthy and happy weekend. Thanks, everybody.